Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 98. As always, joined by the three amigos. We got Keith Dicker, Ice Cap Asset Management, and Rich Diaz, Tom Brady, and Macro. What's going on, Keith? The beer garden. Tell us about the beer garden.
Absolutely. This is the way we roll, right? So, to confirm, we will be hosting. Anybody wants to pop by for a pint or anything? This Tuesday. So today is Thursday, of course, when we record. So Tuesday next, August 29th. Anyone want to come and join us, just send me an email and I'll send you the exact details on where to come. So
man, you're really cutting it close, eh?
Yeah, I know. But I'm a big time money manager and I got other things going on, which is code for Mrs. Ice Cap. And it just takes up time in the summer. That's it. Anyway, anyone wants to come by, it'll be fun.
So send you an email.
Send me an email. Rich is going to come. I know it. Right, Rich?
No, on a school night. I can't do a school night. Not right now.
Tuesday night keg stands
One
at
day.
the beer garden.
One day.
Rich, what's going on?
Man, nothing at all. It's really, really quiet. No dates to speak of. In fact, I got blown off on one. Sorry, that was the wrong language. No. What I meant to say was that. Oh boy. Anyway,
Steve did that.
Two of us, my friend.
Oh,
Steve did that down in South Carolina, didn't he? There a few months back.
What I meant to say was I was stood up for a beer this afternoon, so I think I'll just stick around the office and work a little later. No, the social life has ground to a halt, sadly. Much different than London, which is a bit disappointing, but it's all good. At least I have my Bloomberg to keep me warm. But no, that's it, boys. And it turns out actually this piece of art is real. So
that is a nice piece of art.
There you go. It's apparently worth lots of money. I wouldn't pay for it, but someone out there would. Anyway, there you go.
Yeah, well, I mean, I think it is kind of like the dog days of summer, right? I mean, there's not I feel like everybody's on vacation right now. You're sending out emails. Everyone's got their out of office set up. So I feel like we're at this sort of point in like financial markets where we're kind of reaching this crescendo. It's you can kind of see a building, and like it's obviously I think it's going to ramp up. The news cycle is going to ramp up as you come back post Labor Day long weekend. And so I think there's like a lot of topics that obviously we'll be keeping an eye on. I think the biggest one, which we're going to get into later on in the show, is what's happening in the bond market. I think the bond market tells all, and so we'll get into that shortly, but. Speaking of, summer holidays and whatnot, the Liberal government just came back from their housing retreat in, was it Prince Edward Island, Keith?
Yeah, on the East Coast, I think they had it.
Yeah, maybe they'll come swing by your beer garden.
Yeah, I'd love for those guys to come by.
Well, yeah, there you go. So anyways.
Mr. Prime Minister, you and your cabinet, you're more than welcome. No, it was not the whole cabinet. Wasn't it just a select few? Who attended PEI?
I think there was they were there for like a housing brainstorming session.
Yeah.
Why don't they just call? They should just call Ron Butler and get it. They'll be done in an afternoon. Anyways.
Yeah, Ron Butler, you're welcome back on the show anytime. But anyways, on the housing retreat side, just some interesting comments. Again, not to get overly political on this stuff, but Sean Fraser, who's the former immigration guy, now turned housing minister, has been more vocal of late, and so he's come out during this housing retreat and saying, yeah, you know what, maybe we should be looking at the immigration side, maybe we should be looking at the foreign student side, maybe they're creating excess demand in housing. So don't worry, we're going to review it. we're going to do some more studies and we'll get back to you kind of thing. So
Wait,
they're
did he really
ultimately-
say that? I'm shocked because I thought in
Yeah, like-
Quebec that they discussed that they weren't gonna, push for a cap and what have you.
They feel it's not the best solution. They feel that there's could be a lot of unintended consequences, which is, these schools will ultimately make less money. And so there's certainly the business element of that.
So wait a second. You're saying some of these policies they make or don't make, they may have actual intended consequences. But it's kind of interesting because every time they do a policy, any kind of government entity that you create, or companies as well, you create a policy with your intended outcome, and what usually happens, Rich?
The law of unintended consequences, my favorite.
Yeah, absolutely. Because I love this conversation because it goes into, I looked into the books of some of the universities there a few years ago, and I wasn't aware of it at the time, but afterwards I said, wow, it's kind of quite shocking. So if people are not aware of this, the average university in Canada, and this is average, the number might be a bit different, but anywhere from say 30 to 60% of their operating budget, it comes from the provincial government. So they're giving them, money is coming through. So, I mean, if you're running a company and you need to be subsidized 30 to 60% just to break even, right? That's what these guys are doing. That doesn't work. And then, of course, a lot of people will say, universities, they're not trying to run a profit and loss. And then you get into the American university story. But if you look at the university mix for students, I mean, there's three classes. There's in-province students, out-of-province, and then international students. And if you're in charge of finance at a school, you know which ones has the highest margin on it, of course. It's the international kids. So let's just say it costs 10 grand a year for tuition for a local student to go to school in their province. An out-of-province kid might pay 16 to 20, something like that. An international student could be up to 40,000. My numbers might be a bit off, so feel free to share with us. So it's not surprising that, all of a sudden universities are just, trying to gobble in as many international students as they can because they need the revenue. So maybe we just simply need a new structured education system, right, Rich?
Yep.
No.
Well, I mean,
no, definitely.
To kind of get
Go
to
ahead,
that
Susan.
point, though, we've had a few guests, or not guests, but people that are listeners of the show have actually called us up and said, hey, listen, I work in the immigration side, and these are the problems, and so a lot of the conversation, again, agree, disagree, from these people that I would say are more experts in their field and industry, have essentially said that these schools are really ultimately exploiting this program. They're exploiting some of these students for profit, and it is a very profitable business. Is these private colleges, and so there was actually a great chart here from Mike Moffat. If you haven't been following Mike Moffat, he has been very, very vocal on Twitter. He's been documenting sort of the housing supply side of things in particular over the last couple of years. He was actually invited to the housing retreat in PEI as a sort of expert witness, so to speak, to actually chime in on the housing file. And so one of the things that he's noted is specifically in Ontario, where he's from, is the Ontario international student boom. And it actually shows the number of study permits issued to colleges, not universities, but colleges in Ontario is like literally off the charts. It's just like complete hockey stick. So like something is going on basically since kind of 2019, and it exploded just after COVID. And so, he's kind of highlighted this as basically it's kind of complicated for people listening to this podcast, but essentially the federal government introduced policies to allow more of these sort of students, quote unquote, to enter the workforce or labor force. And so vis-a-vis opening up sort of that criteria has created this boom where people are almost using students as temporary foreign workers.
How dare you? They would never break such rules or bend the rules or do anything like that. I mean, that is just, I'm shocked that someone would take advantage of a loophole as magnificent as that. Is it affecting
Rich,
rents?
you sound condescending when you say it that way.
Condescending or condescending?
I tried to say the right one, but which one did I not say?
But wait, Steve, I mean, a serious question though. I mean, did he go to the next stage and say, number one, are these kids actually going to school, or are they just are they signing up for a class and then heading out to get a job? Again, not necessarily a bad thing if they have a place to live, but we know that they don't. So did he sort of articulate like sort of the next step and what's going on there?
I mean, it's a lot to unpack like a podcast, but I'd really just encourage people to go follow Mike Moffat. He's been quite vocal about this, and maybe we'll get an immigration person that can come on the show and explain sort of, I think, the dynamics of what's happening with these, again, smaller private colleges that I think are ultimately exploiting the program for profit. And again, a lot of sort of the playbook is ultimately created by the federal government allowing a lot of these policies in place, or by changing the rules. These private institutions found creative ways to sort of exploit it. And again, these private institutions obviously don't have a mandate or aren't responsible for creating housing supply for these people, right? That's pushed back onto the municipal governments and the private sector to pull up the socks and build housing. But clearly, we know what's happened, right, over the last, particularly over the last year or two, which is 1 million people a year coming into this country, and housing starts now completely rolling over. If you look at building permits on a national basis, I think they're the lowest they've been in like 10 years. So housing, and that's predominantly a factor of the cost of capital tripling in the last 18 months.
Wait a second. Are you saying the number of permits being issued are the lowest number that we've had over the last 10 years?
Yeah. So if you look at residential building permits, on like a 6-month rolling average over the past, so it's basically at the lowest levels, and I believe it's over a decade now.
On an absolute level. So if we had 10,000 10 years ago, now we have 9,000. Like, that's the direction. So why is that then? See, because I would imagine with the population growing and with the rate cycle and stuff like that, there should have been more permits issued.
I just think it's the private sector ultimately looking at it and saying, like, are these projects financially feasible when like the cost of your capital rises? It tripled. Again, you can say, well, it tripled off a low, a low base. It doesn't matter. It tripled. And like, I think your financing costs on some of these projects are huge input costs.
It's kind of interesting because this ties in with the Canadian bank earnings that started to trickle into the market today.
Yeah. Well,
it's all tied together. These are the unintended consequences. That's the theme today, right?
I think so.
Wait till the panda waddles in and just tips over the tables and everything.
That's the best gif ever, by the way.
Yeah, again,
but it's not just cost of capital, right? Steve, you mentioned to us it's a lot of the taxes and the fees that they have to pay, as well as the time to get zoning and permits and all this stuff. I think it's a sort of an unhappy marriage of several sort of factors, but obviously the cost of capital is one of them.
Yeah. So I'm just looking at the chart right now. Residential building permits, 6-month trend, seasonally adjusted constant dollar. Lowest levels dating back to 2011. So
yikes.
There you go. Again, there's a decent amount of the units that are already under construction, certainly elevated. Those will continue to get built and completed over the next several years. So I suppose that pipeline is probably okay, but it's you're sowing the seeds of a future housing supply crunch today as building permits roll over, because you got to go from a permit to a housing start to a housing under construction to a housing completion, and that's typically a 3 to 6-year cycle.
And to be clear, this is multifamily that you said that there's lots of completion underway, or sorry, excuse me, there's lots of construction underway.
Units under construction is predominantly multifamily,
right, versus
units.
single family.
And I think if you really unpack that further, it's because people aren't really building single family houses in Vancouver and Toronto predominantly because it's just too expensive now, right? I mean, you're going to build one single family house and sell it for $2.5 million. It doesn't work. So the mix of housing has switched from, single family, which would have been 10, 15 years ago, has switched to predominantly, condos, townhouses, things of that nature.
Okay, great. So in a country, the second largest country in the world, everybody's going to be living in a 1-bedroom condo. Just checking. Sorry, Keith. Go ahead.
You're being condescending again.
I am.
Let's switch over to have a nicer view on things. So, Steve, with the I guess the retreat that the government had in PEI this week or whatever, what's coming out of it? Have you heard any conclusions or solutions or anything along those lines? And just try to rebase it again. I mean, the reason for this special retreat was because increasingly now more people are actually starting to blame Ottawa for creating inflation, whereas the narrative beforehand that inflation was caused by other factors that were out of control. So I think it has been a great conversation that people are becoming more aware of the population growth, rates going from 0 to 5 and all that stuff. So I find it interesting that all of a sudden they're saying, hey, we need a solution for a problem we may have contributed to. Was that right, Rich? Did I do that right?
Perfect.
Yeah, okay.
You're on a roll today.
I know, and it's the dog days of.
You're making up for my sluggishness here out of the gate, but thank you.
But what came out of it, Steve? What's the action point they have? Another meeting,
the
right?
Official Bloomberg headlines, not my headlines. Bloomberg's headline says, "Quote: Trudeau tells Canadians to stay tuned on housing solutions." So. No solution as of right now, I suppose. More discussion, more researching, they specifically on like the foreign student thing, and is it contributing to excess demand in the housing market? If you read through Mark Miller's comments, the immigration guy, and Sean Fraser, they both said, well, listen, okay, we've identified it might be a problem. We now need to go and consult with these colleges and universities to make sure that we don't upset them. And so I don't think any solutions coming anytime soon. They've just acknowledged Canadians' anger, I suppose, or comments over the past 3, 4, 5 years denoting this issue. So they said, we hear you, and we're going to bring solution. Now, one of the solutions I am hearing about, and this is certainly one of the reports that Mike Moffat actually co-wrote, and which I think got him a seat at the housing retreat, was alleviating some of the taxes and development charges that are being charged by these governments. Because if you think about it, well, if your cost of capital is tripled, like we need to cut expenses somewhere else in order to make these projects financially viable. And so one of the big conversations is removing GST on purpose-built rentals. So, again, there's a 5%, there's potentially a 5% savings there.
But 1 second. Here's the reaction.
What?
We haven't done that yet, have we, on the podcast, right?
No, we have not. I think that's.
I think
we know somebody insert the laugh track here.
Yeah, that's right.
Well, here's what I'm hearing, and again, it's great. They're trying to come up with a way to, change the supply side of the challenge that we have. And I'm just I think they're just little small, minute moves, and that's not going to make a difference. And they need to be very dramatic with this, and you have to slow down the demand side of it. And it's not pro or anti anything, but if the immigration numbers are 1.4, cut it down to 400,000 again. Sorry, 400,000 for 2 or 3 years. When you have the capacity to grow again, that's when you do it. But this is just treating the symptoms here, like giving someone a break on a GST tax credit. That's not going to encourage anyone to start ramping up supply.
I think it's going to make a very minor difference, but slight difference, but minor difference, not enough to treat the problem. I think ultimately, though, the panda in the room is you kind of need lower prices.
Well, that's what I wanted to say. Yeah, like that's the thing about affordability, right? I think it was one of the first podcasts I ever talked about, which is if housing affordability means your house price falls relative to your income. And I submit to you, sir, that absolutely no politician genuinely wants that to happen, especially when you're about to enter an election cycle. Because if tomorrow house prices were to fall 25%, let's say in Toronto or in Vancouver or what have you, which is their strongholds in what is going to be a very hotly contested election, I would imagine a lot of people who've been, either bought houses, would be negative equity or what have you, I think they would not take kindly to that. And the other thing I think is, and Keith nailed it right on the head, I mean, they've made immigration a cornerstone of their growth project, their growth sort of strategy. Again, what matters, the only thing that matters in life is per capita GDP growth or productivity growth. And for them to do sort of a vault fast they would crystallize and make it very, very clear to everyone that they've made a huge, huge mistake. So I'm with Keith on this. I don't think any of this is going to change. I don't think have all the streets you want.
Let's do a analogy that, a lot of Canadians would relate to. So this is a hockey game, right? And the housing market, like 2-0, 4-0, 6-0, and early in the second period or late in the first, and you got to stop this real fast. So all of a sudden, Chris Pronger is on your team, and the housing market is coming across the blue line, and he's just going to step into it and stop it in its tracks. So that's what we need. Again, we need something here to.
That was a horrible analogy.
I thought it was good. Instead of trying to score some goals to catch up, first of all, you stop the score from going up.
There we go. Okay, that's
right.
Better.
Yeah. See, I'm old school hockey, right? Defense first.
You could have used like a goalie reference or something.
Yeah, that's what I was going to say.
A goalie reference? How would it go? How would it go?
The coach put the wrong goalie in, and if you're going to pull the goalie, it means you made the bad decision. The coach made the bad decision, and you're crystallizing.
Whoa! You can't
Anyways,
blame the
goalie.
goalie.
We need to immediately change this.
You used to blame the goalie? Oh man!
Of course, you blame the goalie.
You never blame the goalie. That's not fair.
Anyways, rounding out our housing.
Steve is not interested in this stupid conversation.
Always the goalies. It's always the goalie's fault. But rounding out the housing conversation here is. Again, yields continue to push higher. So if you fixed rate mortgages across the board, moving up by another 10 to 20 basis points across pretty much all Canadian banks this past week. And so you're seeing the strain on housing affordability, right? Because prices for the most part haven't really adjusted. So on a national basis, this is a chart from Ben Rabideau. I think it was actually shared by Pierre Poilievre in his recent housing interview. But he notes that since basically 2015, the monthly mortgage payment on a typical home using the MLS national home price benchmark and assuming 80% loan to value, 30-year amortization, using your average 5-year mortgage rate, has gone from just under $1,500 per month to today sitting at just under about $3,400 a month. So you've more than doubled since basically 2015.
But wait a second. That's an interest rate set by the Bank of Canada. So I think that's sort of
we're using so his calculation is using the markets.
Yeah. I know, but the Bank of Canada sets that rate, and then you add a spread as you've described, right?
No. The 5-year mortgage rate set by the Canada 5-year bond yield. He's gone back and he's used typical. There is a whole bunch of calculations out there. He's used the typical. What's the advertised 5-year mortgage rate across all the Canadian banks? What's the average today? So I can tell you the average today is about 6%.
Okay, fair.
So he's using the average 5-year mortgage rate going back over the last 7-8 years. And saying, okay, well, if I apply the 5-year fixed mortgage rate and apply it against the home price index for that specific time, what was the average what was the typical mortgage payment across this country. So, anyways, that's where we're at today. Housing affordability still stinks. Let's move across the globe, Keith. Let's get out of this Canada stuff. Everybody's sick of it.
You're sick of the Canadian stuff? I just think you guys need to get back to another cool analogy. And that will do it.
Please.
Okay. Let's move around the world. What do we want to look at? We have jokes aside. Today is Thursday. We talked about this beforehand, but by the time the podcast is announced tomorrow, the Federal Reserve of Kansas City, they're hosting what's called their conference every summer. It's at a place called Jackson Hole, which is a nice place to go. So by the time you're listening to this now, Jay Powell, so the chair of the Fed, he would have already spoken. So he'll do maybe a 5-minute speech. And whatever he has said, right? I'm talking in the past now for the future. Right, Rich?
Yeah.
Yeah. You with me? Yeah, that everything we're talking about now could be blown out of the water a little bit. And so just remind everyone, what last year, this exact same setup, he was not pleased because the market was not taking him serious in terms of wanting to hike interest rates. And the market kept saying, hey, you're finished hiking, we're going to, party like it's 99 again and all that. And he did, I think his speech was 2.5 minutes. That was it. He invoked Paul Volcker. He was chair of the Fed back in the early 80s. And one thing that Volcker did, people think, oh yeah, he slayed inflation and stuff like that. The bank stories was that he did it, but he tried to do it and then he failed, and then he did it again and he had success. And of course, if you're really into your monetary history, you could probably also figure out that he didn't, stop inflation at all. It would have petered out anyway, just by the way the economy was going and all that stuff. But the American economic data, I know we talked about it last week with the GDP estimate that comes out of the Atlanta Fed. That's still really strong. Economic growth is still good in the US. So there is the potential for Powell to come out again and try to sound hawkish again. Now, whether the market anticipates it or interprets it that way, again, we know by now because it's already happened. But this is one of the big data points that's coming out. And as you say, hey, let's go around the world, see what else is happening here, because the whole world is just synergized right now. And as the Americans continue to raise overnight interest rates, or they imply that they might do it because the economy is still strong and stuff, it continues to choke the Chinese, the same with Japan. It causes or focuses on the Canadians trying to, hey, do we keep pace? I know, Rich, you're going to talk a little bit about what's happening with the European data points right now, but we joke about the panda in the room, which we don't mean to be funny about because it's pretty serious what's happening over there right now. But let's be real here. It is the American story that is driving capital right now. So if the Yanks raise rates again, it's going to choke growth elsewhere and attract more capital back into the US.
Keith, what's the likely scenario? I know this is being recorded again on a Thursday, and so maybe this becomes completely irrelevant, but what's your take? What's the likelihood for Jackson Hole here, Jay Powell's speech?
I suspect he's going to his words will be hawkish. He's going to say, hey, the job is almost done. We'll continue to monitor the data and we'll continue to raise rates if we do. They're still concerned about pricing in the labor market, which means wages and all that stuff. He said, no, we're getting close to the end, but we're not there, So it's sort of neutral to hawkish. And I suspect the markets will interpret that as being dovish. So I think maybe there's a great rally going on right now. Tomorrow, which is today. We are creating confusion with this, right?
We are creating a lot of confusion.
We are. But I think our listener will understand what we're trying to say. What do you think happens, Rich?
I agree with you. Well, I was just thinking it's just sort of just keeping people, updated on sort of what the market's pricing in, and it's slowly but surely. I mean, maybe the message is coming through, because we had the probability of hikes. Remember, these are calculated basically off of like different forward curves and sort of a combination of derivatives and sort of implied futures prices and all kinds of math that I have no idea how they do it. But you're starting to slowly see sort of hikes get priced into the markets, and maybe people are anticipating Jerome Powell being more hawkish than I think maybe we were certainly a month ago. I mean, that's what I'm seeing.
And if they do hike, because we have the September meeting coming up, boy, this puts a lot of other economies and markets in a very difficult position, including, we covered the China story before, but Europe is now lighting up again. So anyone watching currency markets over the last 3 days, we're seeing, from peak to trough, the peak moves 1.5%, even 2% in some of these markets. Like, again, like everyone is sitting there trying to figure out what happens next with rates. I know we always sort of, start with the Bank of Canada and move from there, but I think it's really important for everyone to appreciate what the Americans are doing, because it will affect our yield curve, which then affects mortgage rates and things like that. How about you, Steve? What are you reading about?
I'm just curious. I mean,
Jackson
the Bank of
Hole.
Canada's September 6th. I mean, just curious, like, I think I would agree with you, Keith. I think the Fed probably still has another 1 or 2 in them, but I wonder, there's been a lot of conversation in the US in particular around interest rates aren't necessarily passing through into the household channel.
Right.
You look at the US, right? I mean, Rich, what is it? There was a brilliant chart that was circulating on Twitter the other day, which showed something like 95% of mortgages in the US are like sub 3.5% or 3.
Yeah, I don't know if it was 95, but I mean, listen, let's just say for the sake of argument, it was like 3/4 of it were like less than 4, which is incredible given that I think there's 7 and a bit now. So you've got an entire generation of homeowners basically that are completely unaffected by the change in mortgage rates. And yeah, it's something we discussed, Steve, before. So it's not so much really important what the exact numbers are. I'm saying that because I don't have them in front of me. But the issue really is that it's very, very it's just they're just not being affected. However, that's a little unfair though to say in sort of before I'll add to that later. Go for it. Get us.
Yeah, no, I just when I mentioned that, I just look at it and say, well, like, and then you look at Canada, right? I mean, like, yeah, more or less your longest mortgage rate's 5 years, and so I think like the interest rate sensitivity, and the household sector is already more indebted than the US. Like, look at like all these other countries, right? Like, there's been a lot of chatter in Australia, for example, which I would say is a similar situation as Canada, very housing heavy, highly indebted, short-term interest rates on most of that debt. And if you look at retail sales in Australia, I mean, they are horrible. And Canada's numbers just came out. You strip out basically gas prices that went up and car sales, which are kind of lagging. Retail sales continue to roll over. So I struggle to see a scenario where, I mean, maybe the Bank of Canada might want to keep pace, but I just think that Canada is going to roll over well before the US.
I mean, you said Canadian economy is going to roll over before the US, or the Bank of Canada will?
Canadian economy for sure. And then does that put pressure on the BOC? Like, I just think obviously, you're doing your best to keep pace with the Americans, but and we've talked about it. I think, the Americans are the cleanest dirty shirt.
The one of the economic surveys for Canada came out over the last few days. I don't know which day it came out on. But there were, I think, 7 respondents, and they're all from Scotiabank. No, they're spread out across the big banks and a couple other shops. But it's interesting. One of the big data points that came out of that survey is a chance of recession happening over the next 12 months is now 45%.
45. Everybody's
Yeah, so
lowering
now we
their
have a fifth. Yeah, like things are even that the estimates, everything is getting a little bit weaker. And but so this is an interesting fact for people to know. So the the Association of Professional Economic Forecasters, I think that's the right name for it.
Yep.
Rich has been dying to get accepted into that group.
No, they're always wrong. They're always wrong.
Anyway, but it's an American group, and so I think it's been in existence since 69 or 70, something like that. And it's their job, basically. You get the consensus number, where's GDP growth going to be, for the American. And since they've started, I think there's been 9 or 10 recessions over the last, what are we looking at? 30 years, 40 years? What do we look? 50 years now. And so to say there's been 9 recessions in total, this group has predicted 0 of them, right? They've never been right. Which means it's really hard to predict a recession, or the inherent bias towards positive growth all the time. You never want to predict, a bad number. I think that's in there as well. But if you look at their estimates, not only do they ever not correctly predict a recession, their average estimate has never been negative either. So it's always you got this positive, influence in there. So with the Canadian survey here, there's only 7 people involved with it. So even that, their average economic growth for 24 coming out is 0.8. So they're saying we're going to slow down. We're going to go from, say, 1.5% in 23 down to half of that next year. And there's a 50% chance that we do roll into a recession. I think the Bank of Canada will be thrilled with that environment, because it is telling you, hey, we get this soft landing everyone wanted. But, you start, looking through the weeds and everything, that ain't going to help the housing market. It ain't really going to help wages and all these other challenges that we're having in the economy. So anyway, that's one thing that caught my attention. Plus, the Canadian banks started coming out with earnings.
Well, speaking of banks, Keith, how much stock do you put in? Pun intended, but looking at KRE, so the regional banking ETF in the U.S. there, it's kind of back to levels last seen when Silicon Valley Bank imploded there. And you've seen the price action more recently in Citigroup. You've seen the some of these downgrades to these banks as well. I mean, is that the market starting to sniff something out?
Yeah, you always have to look at the relative performance of bank stocks. What do I mean by that? You take the bank stock index relative to, say, for the Americans, relative to the S&P. In Canada, you might want to do it, to the TSX, but it's a Canadian stock index, by the way, guys. It's a very unbalanced index. It's so heavy with energy stocks on one side and financials on the other. But if you look, if you just switch over the Canadian story, for example, you pull up the 5-year chart on any of the bank stocks, it's weak. Like, they are headed in the wrong direction. And they're always forward looking, the equity markets are. And if we have the part of the economy that provides capital or credit to the economy, and if that's weak and then they're contracting, because RBC, they announced, they're going to lay off people. I think it's 2% of their headcount they're going with. You look at the provisioning on the loan losses, how much are they lending out and everything. It does point towards, things are getting tighter. And in the US, the story is a little bit different, because a lot of investors are saying, wow, I don't trust the small to mid-sized banks. Maybe the Silicon Valley story hits their banks, something like that. So the money is flowing up to the big guys, and that gives them a huge advantage then with funding cost on
but you have to be careful,
deposits
though, because
and stuff.
You have to be careful, though, because small bank deposits have been rising all summer. And so, a lot of this worries that we had about whether or not these banks were going to go bankrupt or whatever, I think that was totally overblown. I mentioned it at the time, and I'm reiterating it now. And one way that you can look at one of the issues that they had, and one of the issues they were trying to stem with the U.S. banks, is with the deposit flight, right? And then banks are extremely highly levered. They have a lot of assets on one side of the balance sheets and liabilities and equities on the other side. And when your assets start to go away, e.g., your deposit starts to flow out, then it puts a lot of pressure on your equity holders and what have you. So that's reversed a lot. And so you can see the small bank deposits are starting to rise. The other thing I think it's important to note is that there is sort of a credit crunch going on in the US, but most of the lending for the real estate market in the United States, I understand it's constrained because there's not enough housing supply in the US in similar way as Canada, but it's a spread. So you have the mortgage rate over, let's say, a bond rate. And so the US, they lend on a 30-year fixed rate mortgage, contrasted with Canada, which is only 5. And the mortgage rate spread over the 30-year bond is the highest it's ever been on my chart. So that's 45-year high. That's 45-year high. It's 3%, which is incredible. So these banks, it's not that. So there is some appetite for lending. It's just you got to figure out where it is and how it is. And the other thing I think is really important to note is that all Canadian banks are not created equal. So we treat sort of the Canadian banks as this amorphous blob, but each bank will have a significantly different exposure to the Canadian housing market relative to other ones. So the way that you look at that is just simply looking at their assets and liabilities, and some of the assets are like loans to residential mortgages. So BMO, I know, is at the bottom of that list, and I think it's only like 20% of their loan book is from residential mortgages. And at the top of the list, you might have CIBC or whatever. I can't remember the exact name chart because my computer is too slow and I can't load it for some reason. But it's just, you have to be careful about sort of lumping all of the Canadian banks together. We know that, for example, TD has an enormous asset management business in northeastern United States. I mean, if you watch hockey and know hockey, there's something called the TD Garden where the Boston Bruins go suck every year, and we hate the Boston Bruins. But they have an enormous business in that part of the world, and so you just have to be careful about. And I'm sure that'll come up in the non-performing loans and the provisioning and stuff like that. So sometimes I know we're only 5 banks in Canada, and we all treat them the same, and we pretend they are the same, and in many ways they are the same, but they're not. They have different businesses, Keith, and so that's why I thought it was important to sort of add that color.
Yeah, I kind of disagree with that paintbrush.
What do you mean? They literally have
Canadian
different
banks,
asset holdings.
No, Canadian banks today are more homogenized than ever. And what I mean by that, if we get any kind of a funding crisis on the curve, all the banks are going to suffer. Money is just going to flow out of the Canadian dollar, flow out of the bond market. Their balance sheets just get whacked. I think in a normal economic cycle, what you shared with us is correct. But my fear that this is not a normal cycle. Again, like we've gone from 0 to 5% in 18 months. And as soon as we do hit something that's a bit nasty out there, money just runs. I mean, it doesn't sit around and try to figure out, which bank has this exposure and that exposure. And that's the real risk. Because if you look at the bank stocks now, like in the 5-year chart, one of them with the blue shirt has done a lot better on a relative basis than the others. But 2 or 3 of them, I think 2 of them are now down back below the pre-COVID level. Yeah. I'm not saying names, of course. You could pull up the charts and see them. And I think another one is just sitting on that line as well. Like we're in this weak moment here. And if you look at markets today, which again is, Thursday before, the Friday Powell speech and everything, the US dollar is ripping higher again. Even we got to talk about the BRICS story. Weren't we going to talk about that? We mentioned there earlier.
Oh,
right?
yeah.
But the last, we had a really interesting currency phenomena there 2 or 3 days ago where, Euro, Yen, CAD, and Aussie, they were just getting smoked by the dollar. And meanwhile, Brazil Real, as well as peso and rand, as well as South African rand, these were ripping higher, because you had all that euphoria building up, and these BRICS guys are going to create their own currency. I know Rich is all over it. Like Rich can't wait to move to these places and buy the FX and all that. But again, like back to the Canadian story, there's stuff happening here that's being driven by movements outside which goes back to Steve's point all the time. Like, because no, Steve, you're leading quite a bit now with, where's the 5-year mortgage rate, which is really just a take on the 5-year bond. And I know you talk about the 10-year, maybe that's a good time to buy it at some point. But I just think we're at this, pivotal moment, and the second half of the year could be a complete mirrored image to the first half of the year.
Yeah,
and the first half was good. So, Rich, when you look in the mirror, you're getting a reverse image, right? You know that?
I think I think it's setting up to be a doozy. Rich, I just wanted to finalize our U.S. housing thing here, because we talked about Warren Buffett's big buy into these U.S. home builders last week on the podcast. So the data that came out a couple of days ago showing that new homes made up 31% of all home sales in the second quarter, highest share on record for any Q2. That's in the U.S. So again, like the home builders obviously haven't had any competition. And so that's where the inventory story has continued to play out, because these people are basically, sitting on 30-year fixed rate mortgages at, 3.5%, 4%. And so it hasn't freed up any housing inventory, and which I think ultimately, let's call it what it is making the Fed's job much more challenging. It's just harder to, monetary policy works with lags, and obviously, when it's just harder to pass through those debt servicing costs if people are locked into their houses.
I think speaking of lags, I think maybe we can spend just a few minutes about with Europe. Is that okay?
Sure.
And what I mean by the lag part of it, the ECB, they've been lagging the Fed with the size of their rate increases, and when they start it and stuff like that. And where's the ECB now, Rich? What's their overnight rate?
375 off of memory. That was my guess. Let me double check.
375. Do I hear 4 and a quarter? Anyway, of course, the Fed is a bit higher than that, and they've been talking hawkish. Remember, so is the Fed. And the challenge right now, though, is like, whereas the Fed is, looking and hoping to see weaker data, because this is what everybody wants. Even here in Canada, the Bank of Canada, they want to see the labor market roll over, and all that stuff. So whereas the Americans are hoping to get weak data, and it's not really happening. What's happening in Europe? This is your moment, Rich. This is really
Sorry. Yeah. I mean, the data is really not good. Again, it depends on what you're looking at, of course, but the stuff that came out yesterday really sort of took me for a loop. We've talked about diffusion indices a lot, and they came out in Europe. And so France, Germany, the UK, and also the global one. It wasn't so hot for the US, but we'll get to that later. So we've talked about different types of diffusion indices. One of them is obviously manufacturing. Services a much larger share of the economy. And I think not one of them is above 50. So of the 3 for France, the 3 for Germany, the 3 for Europe, obviously that includes France and Germany, and then the UK, not one of them is above 50, and many of them fell much more than expected. And so basically it just tells you sort of what we've discussing a long time, is that economies that are, for example, tied to China, Germany, are doing very, very badly. And even France, which has actually been more of a bright spot because it hasn't had the exposure to the energy problems. It has an incredibly strong labor market, believe it or not. Its equity market is luxury brands and sort of outside the industrial space. So it's actually been doing relatively well. Even they are starting to sort of see some real weakness there. And then that doesn't even get into the whole lending issue. And loans to non-financial corporations and loans to mortgages, that's been coming off really significantly. I think it's negative in real terms, certainly, which is a big deal when it comes to lending. Europe is just it's really not looking very hot.
So Rich, I got a question.
Yeah.
So China's not doing so well. Europe, in turn, is not doing so well.
Right.
Is that not a case for bonds?
I mean, I think there's loads of reasons why you want to be getting involved with bonds. I think that's one of them. I think, the one of them is because you're finally getting paid to hold them. Real interest rates are in the 2s and high 1s.
Is it the high? How long? But that's the high. Real
Yeah,
yields.
it's the
of
highest
2%.
it's been the highest in 10 years or so. Yeah, for sure. So real yields are offering you something. You got worries about you got actual nominal yields are okay. I mean, obviously nominal yields, I think 4.2 or whatever in the US. Then you're worried about growth. But the problem is there's like that's like sort of why you might demand a bond. But then there's the supply. I mean, the US is running an 8% budget deficit. China, as Keith's pointed out many times, is selling up their treasury reserves, or sorry, their reserves rather, in the form of treasuries to prop up their yuan, which is just their yuan, which is under a lot of pressure. I think if we're not at a high, Keith, I think we're basically flirting with it. And so you've got the balance between supply again, and then this demand. And I think that, so yeah, I mean, is it interesting to be looking at bonds? I definitely think so. There's something called an equity risk premium, which is sort of the extra return that equity investors demand over buying sort of a risk-free asset. That's quite an ephemeral sort of like, number that doesn't really exist, but a bunch of academics try to argue and try to figure out and model. In any event, however you want to calculate it, it's basically at a 20-year low, meaning that the relative value from owning equities and bonds is basically the best it's been in a long, long time. Keith talks about a reversal of the first half of 2023. One of the ways that could happen is sort of the equity market does badly and the bond market does well. So meaning bond yields go down. Really, really interesting. I think it's absolutely an interesting time to think about it. But that's all of those arguments, though, where you could have made exactly 6 months ago, which makes this very, very tricky. So there you go. So that, I mean,
I think I just figured something out.
Uh-oh.
So when you're going on a date, are you talking about the bond market, or are you talking about like AI stocks? Which
AI
one is
stocks, for sure. AI stocks. AI.
AI stocks.
Nobody gets excited about bonds.
I know, right? That's the it depends on which demographic you're
this decade. Not this decade.
Maybe you should go to the bingo halls on Saturday nights and talk about the bond markets. Maybe that would be a bit more successful. But like sort of back to Europe, though, again. So, I mean, the ECB are now in this really awkward position where growth is slowing down. If inflation is still sticky, it's not because of the demand side. So raising rates doesn't do anything anymore. So they could be on the verge of already getting stopped out. So that would be really the first major bank to have to admit it. And if that happened, because now like the euro, I think euro peaked at around maybe 112 4 weeks ago. I don't know how long ago it was there. And now it's sort of having a race with the yen over the last week. And to go lower and lower here. But again, if the Yanks raise rates, and the ECB doesn't, or they sound dovish, it's going to be really tough. So Europe is like back on my screen again, something I'm watching. But in the bond world, if you're going to buy a European bond, again, there is no federal Eurozone bond to buy. It doesn't exist. So what that makes very different than compared to, say, the Americans or here in Canada, because we have a federal government bond. The Americans have treasuries, of course. China, you cannot buy any Chinese bonds. In Japan, you can't really buy them because the Bank of Japan holds them all. So you dive into Europe, and you're going to say, what, the economy is coming off. I heard Rich kind of likes the bond market during bingo when he's playing.
Bingo
so
night.
do you buy the German one or the French or the Spanish, Italian? What do you do?
Well, the German one.
Yeah, and the only ones buying it would be like inter-European money. It has to stay in the Eurozone. But a foreign investor is not going to run out and buy it. Because what's the yield on the German 10-year now, Rich?
Oh, I don't know.
Rich?
I mean, when I talk about the bond market, just to be clear, I mean the U.S. Treasury note. I mean the 10-year U.S. Treasury bond.
Of course, I know that as well.
Oh, okay,
I'm just sort of beating up on the.
Sorry, it's 2.5% in Germany. In the U.S.
I see the same number. Yeah, 2.5. So if you're a foreign investor, are you going to buy one that's paying out 2.5, or do you want to rather have a a 4.25 yield.
Right.
And you know that if you buy the 2.5 yield, you're going to lose on the FX side as well.
Yeah, that's what I was just about to say.
Yeah. So again, it's a tough position, that the world is sort of headed towards, and no one's expecting a recession. No one.
The no landing camp.
Well,
No
I mean,
landing.
they've been right. I mean, that's the thing that makes these markets so particularly interesting. And when you get decent when you get decent earnings out of one of the biggest, most important tech names in the world, it props up the market and it sort of pushes this recession talk further down the road, which is what. But I mean, that's why this is why, like, yeah, part of our job is being right and being right at the exact same right time, because being early is the same as being wrong. And that's what's been so fascinating about this year, because again, a lot of these arguments you could have made, 3 and 6 months ago, which is slowing Europe, China's in trouble, US is getting tighter on the credit space, the labor market's slowing down. And yet what we saw was bonds sold off and equities rallied into that news. So it's, Keith, I mean, are you really sure that the next 6 months are going to be the reversal of that?
Yes.
Yeah, so am I. So do I. Oh, that's
You didn't hesitate.
Yes is the answer to your question.
Yeah, no, I agree.
Do you remember the movie Love Actually? Yeah. Do you remember that movie, Love Actually?
Yeah, I do.
From a long time ago. So one of my favorite scenes is Mrs. Icecap and I, we like that movie. And one of my favorite scenes is when the character, it's a Hugh Grant. Was it? No, not Hugh Grant. Colin Firth character. He chased after I think it was a Portuguese lady or Spanish, I forget where she was from. And he went to the restaurant and he's down at the bottom and she's up in the second floor, and in Spanish, I think it was, or Portuguese, whatever he spoke to her, he proposed to her, and of course she responds in English because she was also trying to learn his language, and her response was, yes is my answer to your question. So my answer to your question, Steve, is yes.
It's amazing where
it's
your
a
brain
great
goes.
scene. I know, right? It's full of it.
You've got more movie quotes dialed in than I do. I thought I was good.
It's kind of funny. You were talking about France and Germany there earlier. One economy is more dependent on China than the other, and one's dependent on Russia. And so again, this is the way my mind works on the Loonie Hour. I'm thinking, remember that song by the Killers, Mr. Brightside?
Love that song.
Yeah, it's good.
Yeah. I'm thinking, okay, in that song with the lyrics, does it apply more to the French or the Germans? I can't decide.
Oh man, I have no idea what you're talking about.
You're a strange dude. That's why we love you. I think that's a good place to cap it off. Give everybody a break. But
next week we can talk about the BRICS and the US dollar reserve.
Yeah, Rich is not a believer. Let's put it that way.
Yeah, I'm with Rich as well on that one. I'm with Rich, and don't forget Icecap Beer Garden. We'll be reliving those moments next week as well.
The Icecap Beer Garden is nothing that goes Tuesday night. What a strange time for a beer garden, but nonetheless, be there, be square. If you guys want access, just send Keith a direct email. It's not hard to find on the Loonie Hour. LoonieHour.ca is the official website if you haven't checked it out. And as always, we appreciate the support. We'll see you next week.